Hello everybody, this is Toni Turner and welcome to the market now as of about noon Eastern on Friday, August the 18th. Wall Street was lower for the second straight day today on mounting worries about President Donald Trump's ability to legislate his pro-growth agenda. The S&P 500 posted its biggest one-day percentage loss in about 3 months yesterday, Thursday, with all three major indexes on track to post their worst monthly performance since October. Also weighing in on investing sentiment was news of two terrorist attacks, both yesterday and today in Barcelona and today in the Finnish city of Turku. And on top of all that, we also do need to remember that markets typically get volatile in August and September. So this is not an unusual thing to happen this time of the year. With all of that in mind, let's look at three charts that could give us some insight into the week to come. First of all, as we normally do, we're going to look at a daily chart of the S&P 500 Spider, symbol SPY. As you all know, this is the tracking stock that closely correlates with our benchmark S&P 500 index. Now, as you can see, the S&P 500 made an all-time closing high, as we've mentioned before, on August 7th. And that closing high was $247.87 right up here. Since then, it started rolling over a little bit. It's fallen below its 20, the red line on this screen, the 50-day, the green line on this screen. It fell last week below these two moving averages, then bounced, thank goodness, but then rolled over again and then fell below the 50-day moving average, and that was Thursday yesterday. You will see that yesterday we did have quite high volumes, so this was a disbursement day, we call it, when true selling did come in, no kidding around selling. This day last week was also a disbursement day, and you see the high volume there. So there's definitely some selling going on, some institutional selling going on in this market, and we just might get a little more of a retracement here. So the S&P 500 Spider, when I captured this chart today, was trading at $243.19. This is about 2% down, a drawdown from its all-time highs on August 7th. Not too bad yet, certainly. Certainly in the longer term, we're still in an uptrend. However, yesterday's fall did move below the pretty long-term trend line that I've drawn here underneath price. And so that also comes in right about where the 50-day moving average comes in. Both of them come in at about $244, $245. So since price has fallen below that level, both these lines come in together, which means they're now pretty strong. This is a strong area of resistance here. We'll have to see if the last 2 weeks in August, which are typically very dicey, a lot of people are on vacation. If they haven't gone, these are the 2 weeks that they do go before we move into September. So to see the market rally in the last 2 weeks of October would mean that there are a lot of brand new buyers out here that we certainly didn't expect. Now, getting a healthy pullback here, I think, is a good thing. I do think we have a lot of overvalued stocks in this market. Personally, I like to see a retracement every now and then because it offers so many more opportunities in the coming days and weeks. So we have this resistance here. This is the time of year I typically raise cash in order to so I can take advantage again of the bargains I'm going to find toward the end of September and going into October. So we'll have to see here. Now we do have support here down at 242, as you can see. We have more, and right around between 240 and 242, which would be 2,400 on the S&P 500 itself. We also have more support at 235. Coming in under here, and we also have more support at 232, which would be about 2320 on the S&P 500 itself. So we've got quite a bit of support here. We also have right now the 200-day moving average coming in at $234.53. So a lot of potential support here should the S&P decide it wants to draw back more to a 5% retracement. Quite a bit of potential support here. And unless we see an exogenous shock come into the market, we may get a retracement back down here that will be a gentle one and again offer more opportunities in the weeks to come. Our next chart we're going to look at is a daily chart of the iShares Russell 2000 ETF, symbol IWM. I've told you all before that small caps are typically U.S.-centric. They typically do not send their goods and services overseas. Now, small caps are typically valued at between $300 million and $2 billion. And what we see here is the IWM had a closing high of on July 25th up here at about 144 and change. Then the next day we had a complete reversal day here, an outside day, pretty close to an outside day, and that's what started this move down here that you see on the IWM. Now, why do we care about the IWM or the Russell 2000 Small Cap Index? We care about it because many times we've found that the Russell 2000 Small Caps can lead us out of a bull market and into, if not a bear market, into a retracement. Excuse me. We also know that the IWM, if we're in a bear market, can turn around and reverse. It usually reverses first and starts us back into a bull market. So we kind of look at the Russell 2000 as a leading indicator. And in fact, it did roll over, as I said earlier, in July, and as you can see here, and it has moved down. It broke right through its 20-day moving average at the end of July, right through its 50-day moving average, didn't look back, broke back down, and yesterday broke below its 200-day moving average, which is currently coming in at $136.73. Now, when I captured this chart today, the IWM was trading at $135 and a couple of cents. As you can see, and as I just pointed out, it is below, excuse me, the 200-day moving average, which once price goes below the 50-day, that's not a good thing. But once it heads down below the 200-day, then we can say whatever asset that is really internally weak. We've seen quite a few disbursement days here. No kidding around disbursement days. And so money right at the moment is flowing out of the small caps, and there's reasonable volume on this. We can see now that the RSI is coming down to its oversold area, the 14-day RSI. We can also see that the MACD, of course, the signal line is below the MACD line, and it is down, getting down to oversold area. So the IWM may have a ways to go here. It's currently down 7% off its highs. It may need to wander back down to this support area at about 132.50 that took place back in March of 2017. It may not. Of course, it will probably not go in a straight line down, so we don't have to worry about that. But we do want to keep an eye on it and see where it bottoms out here. It may take it a couple of more weeks, or it may turn around very soon. But again, we want to keep an eye on it to see where it turns around, because it can act as a leading indicator for the market. So as long as the IWM is going down, I'm holding some dry powder here so that I will have some funds to invest in, as I said, the new opportunities that are going to appear in just a few weeks. Now let's go on to, speaking of opportunities, let's go on to our final chart for today. In Toni's Market Club, which meets every Monday, and I'll talk about in a minute, we are sincerely looking here at the Van Eck Gold Miners ETF, symbol GDX. This is a daily chart of the Van Eck Gold Miners. We got more defensive this week in Tony's Market Club for very obvious reasons. Again, we have, the administration is having some rockiness in it. We also have had 2 terror attacks this week, and the seasonality of August and September being cranky in the market as well. So we got more defensive this week. I think it was time to do so. And we're looking at the gold miners, the Van Eck Gold Miners ETF, symbol GDX. Now the GDX, the Gold Miners ETF, top components are Newmont Mining, Barrick Gold, Franco-Nevada, Gold Corp. You've probably heard of most of them. And as you look at the chart here, you can see that back in February, the Van Eck Gold Miners was trading up at about $26. Since then, it's gradually made a downtrend, making a series of lower highs, lower highs, lower highs, although the lows down here at about 21 have remained even this whole time. So price of gold miners comes down to 21, then rallies back up, makes a lower high here, back down to 21, makes another lower high, comes down to 21, and is rallying up once again. Now, I'm watching here a pattern maybe some of you can see. It's an inverse head and shoulders, which can be a very bullish pattern. We can use that as the shoulder, or we can make this the shoulder, because what you want to look for here is basically, and sometimes it's hard for these shoulders to get exactly where you want them, but right for today I'll use sort of the 200-day moving average, or not that, but this a line following it. And we can see here that the GDX is breaking out. Now it's ever so gentle, and it is trading now above the green line, the 50-day moving average, the black line, the 200-day moving average, and the red line. So it's broken out here. It's about neutral on its RSI and its MACD, pretty much neutral here. As you can see, it broke out today over resistance at about $23.25. It's come back in a little bit today as prices of the market have stabilized somewhat. But I'm going to look at this GDX into the coming week. And as a defensive play, maybe buy a few shares if it can start moving higher here again up toward 23.50. As you know, my stop is always a close underneath the 50-day moving average right here. So I will, if we get into shares next week, or if we maintain some that have already been purchased, we do want to use the 50-day moving average coming in here right now at $22.32 as our line in the sand to get out if price falls below that. So this is a defensive play. Again, if August and September remain rocky as they normally do, this may be a place you want to look at. And now on to next week's economic reports. But first, please join us this coming Monday, August 21st, for our next session of Tony's Market Club. We'll talk about which side of the market to be on, and that may be a little dicey, so you may be glad for the guidance if you join. We'll have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. And by the way, Tony's Market Club has now been around for over 8 years, and I know that many of our members are very successful, and they've been with us the whole time, and I'm sure they wouldn't stay with us if they weren't making money. So please join us. We have a great group. For those who cannot attend our live session, not a problem. The recording of our session is available to all of our members just a few minutes after the session ends. Now, for more information and to join, just go to tonysmarketclub.com. And now on to this week's economic reports. Very low economic reports this week, thank goodness. We don't need any more excitement. So nothing much going on Monday and Tuesday. Wednesday we have new home sales and crude inventories. Thursday, we have jobless claims, existing home sales, and natural gas inventories. And Friday, we have durable orders. Again, join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading skills and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is the Market Now.